Welcome back, Alpha Hunters. Okay, so the market just closed for the week of May the 13th. Yep, that's right. It is Friday the 13th. So hopefully you're not superstitious because the market definitely was not today. We saw a very strong day today. And I'm briefly going to go over kind of what went on this week. And then I'm going to show off a lot of analysis over the two previous bear markets. I'm not going to talk about 2020 because that wasn't really a bear market, even though technically it was. It was just a fluke, 4 weeks, pandemic crash, okay, all that, you know it. All right, but I'm not going to talk about that. So I'll talk about some analysis of 2007 tops to their bear markets. And then we will look and see what we can expect and extrapolate and plan for going forward, as I think we are going to get more into this bear market. Okay, so this week, well, we started off the week, let's say not strong. I'm not going to say weak, not strong, okay? So Monday, I'm going to zoom in here a little bit. So Monday, we opened down and just kind of sold down. We got to my 400 price target finally filled this gap from April of last year. So over a year, it took us to fill this gap on the SPY. And then we just kind of chopped around there for 2.5 days. This upper wick of Wednesday's candle, we were just kind of hung out there. So let me go to intraday chart, zoom out here. So we have Monday, we just kind of sold down. Tuesday, we opened higher and just kind of sold down. And then tried to bounce a little bit. And then Wednesday, we just kind of opened, traded up, stayed relatively within the zone for most of the week, honestly. Second half of the day, Wednesday, we just kind of sold down, just started rolling down. And then Thursday, just kind of got down, had a little bit of bounce, then we rolled over late in the day. And then towards the end of that day, that was pretty much it. Very strong buying came in. And I'll show you what this line is that you see at the bottom of the screen. It's kind of funny that we went down and hit that line and really started bouncing right there. So I'll show you what that line is here in a sec. And then we bounced for the end of the day, Thursday, and then it continued into Friday with a strong buying, some selling midday, and then we kind of closed out the day with buying. The very important thing I was really watching, I kind of was looking around and talking with some people. We really needed to close above 400 or 4,000 on the ES. So we definitely did do that. And I was kind of glad we did that. I didn't think it would have held down, especially with, if we look at a weekly, we already had 1, 2, 3, 4, 5 weeks in a row where we sold down from our open. Now we can mark number 6 in the books. So I do think we'll have a green week next week, kind of regardless, because 6 weeks red in a row is usually like that trend kind of just ends eventually. And with that lower week that we put in this week, you definitely saw some buying kind of come in second half of the day yesterday and today. So that's kind of what went on for the week. And let me zoom out here and we can see what the heck this line goes all the way back to. And it goes all the way back to the beginning of this bull trend. And we have 3 lines here. Really, this upper line is pretty much been the upper end of the trend that we've been in. This middle line is the middle of the trend that we've been in. And then the lower line is, the lower area of the trend that we've been in. So it was just kind of funny that we kind of came right down to that line that's been going through the middle of this trend area that we've bounced off of numerous times. So yeah, it's kind of interesting. We kind of got down to that line. And the other interesting part about where we bottomed, and I saw some other people put out some pretty good analysis on why they thought it might go to right around that 3,900 level, and it got below 3,900. So 3,900 to 3,850, or 390 or 385 roughly on the SPY. We definitely saw it get to about that level. And again, from that trend, so this bullish trend, that was roughly a 33.6% pullback of the trend, not from the all-time high, but as far as from the bottom to the top of the bull trend that we were in for the past 13 years, that was roughly a 33.6% pullback of that entire trend. So that was just very interesting to see that. So where do we go from here? I definitely think over the next few weeks we'll be bullish. So let's now switch gears and talk about some history, and we'll see where we can go in our current marketplace, okay? So I'm going to change the date here. We're going to go back in time to 2000, May 13th, okay? So I'm going to go back, and it's really this time period. It's the bear market from the tech bubble that busted And it goes from March of 2000 to October of 2002. Okay, so each one of these lines is corresponding to some data that I'm going to show off here in a sec, but they are basically the trend that I kind of did some analysis on, right? And so the first line down, we had a snap down, then we had the buy up, you know, the down, up, right? All the way down. And I wanted to do this because I kind of want to know what kind of history says about some of the choppiness that kind of goes on in the marketplace. And there definitely is some choppiness, right? In the beginning of a bear market, it's not clear. Like we're not down 20%. We actually don't get down 20% from the all-time high in 2000 until we get to this right here. We break down that low. We almost got to it right here. We got down 18.8% right there at that bottom. And then 20% down from that all-time high was roughly below it. Obviously it's gonna be just below it. And then we went down quite a bit, quite substantially. So that's about the 20% down mark, was right there. Broke down through it, and we saw we kind of just chopped around there for about 2 additional weeks. So that was very interesting. But when we got all the way down here at the bottom of that trend, we were down 30%, 30.5%. So we can definitely see that, you know, we're definitely going to start to get to that time period in the bearish market where we're going to have some breakdowns, okay? Now, the other interesting thing to know is in the tech bubble bust, we actually didn't get below the 20%, the bearish market, for about 11 months. It took 11 months for us to go from all-time high to bear market. So we didn't even do it any time in the first 6 months, 8 months, 9 months, 10 months. You know, we didn't do any of that. So it took us almost a whole year to get down 20%. Okay, so that's another interesting thing that I thought was kind of neat to see. The other thing I kind of want to notice, I want you guys to notice, I definitely did notice this when I was doing some of this analysis, was how choppy the beginning is, right? We down, up, down, up. I mean, we're doing a downward trend here. Yes, we are, but we very much, it's very choppy here in the beginning compared to later on as we get into deeper into the bear market. You know, we're just real choppy. Even this trend that we had here, this little second trend line, we got the first trend line, we got the second. We were very choppy throughout this second upward trend here. So it was very choppy in there, and I thought about marking each one of these during this uptrend, but I didn't want to do that as it just kind of kept the trend going up. It's just very choppy. So I definitely want us to be very clear and knowing what we're looking for as we are trading our current markets today, as we can expect some more choppiness to come in, okay? So each one of these lines corresponds to a move that we have here, okay? So each one of those lines, those trend lines that I drew out there, corresponds with a move here that we have in this tech burst, right? Now this is the 2000 to 2002 tech bubble burst. And one of the things that we can kind of see, and I put a lot of just basic information on here, right? So like obviously the market top was March 24th to the downtrend of April 14th. So we can see a lot of information here, and then what the highs and lows on those days were, okay? And then what was very interesting to see, right, is we had a percentage move down of 14% roughly. Then we had a percentage move up of 15%. Now, what we know, or just about basic statistics and math and percentages, is when you're at a higher level and you go a percentage down and then you go a percentage up, even though it's the same percentage or roughly the same percentage, it won't be equal, right? You'll be underperforming as you're taking a roughly the same percentage of a smaller number, so the move just isn't the same, okay? But what's very interesting to know here is a lot of the percentage moves down are roughly matched by a same kind of percentage move up, okay? Now, this is probably the largest discrepancy that happened during the 2000 tech bust. Most of them are really close, 13% to 10.5%, 22% roughly the same, 29% and almost 26%. Then we got 34% and down, and then 25% up. So that was obviously the big one. And then that was the bottom, then 20% back down. So it was very interesting to see kind of some of the similarities and things that we can kind of take away. Okay. So that was kind of the first thing that kind of popped off to me. It was like, oh, it's, a lot of the bullish moves back up are pretty close to almost all of the move that we had back down, right? And I actually tracked that here. This is the text here. It says bull response, right? So after we get the bear move down, what is the bullish response? And the bullish response on that move was 105%, 71%, 81%, 100%, 89, 73%. So they do retrace quite a bit. And if we do go back to the charts real quick, if you do look at these moves, down, up, down, up, down, up, they overlap the previous low, right? So we have a low here, and as we broke that down, we overlapped it to the upside. As we broke down this low, we overlapped it to the upside, right? As we broke down this low, we overlapped the previous low to the upside. If we broke down that low, we overlapped it to the upside, okay? And we broke down again, we overlapped it to the upside. So there's a lot of overlapping of previous lows to, the upper peak, I guess we can say, the upper peak as we're in the downtrend. And what I kind of want to tell you is, we're not going to just water cloth off the edge. And I get it. A lot of people, the first time you're seeing a bear market was 2020. And I don't really like analyzing 2020 because it wasn't really a normal economic cycle. It was a pandemic. It was a one-off. It wasn't normal. So I don't want to analyze that. I just kind of want to forget it happened ever. But, we can't. What we can see here is we do have a bullish response of 80%. So anytime the market rolls over and goes down to a new low and we get the buy up, wherever the bottom is, we can expect the market to go up roughly 80% of that peak to bottom move. Okay, so what I mean by that is, as the market goes from this peak to this bottom here, we can expect the market to come back roughly 80% on average. On average 80%, right? This peak to this bottom, we can expect the market to come back up about 80%. So that was very interesting to kind of see that. Now this bull response number, this does take into account the 07 to 09 analysis, and we can see that this bull response was actually only 57% and this one was 62.5%. There was a lot of differences that kind of went on with the financial collapse that happened, as there was just so much leverage in the system. And when banks started to fail, there was really too much chaos that kind of ensued, and that's why we had the financial collapse. Okay, so I really kind of don't even like analyzing this, but what I did here was these first two bull responses from these two bear markets. So I only took the data here from the first two on each one of those bear markets, and we can see it's roughly 85%. Okay, now what's interesting is over on the right side here is we have one that we have already put in, right? We have roughly an 86% bullish response to a bear trend. Okay, so the bear trend was roughly 14.5% down. The bulls responded with roughly 87% of that move to the downside back in the bullish direction. So we can see that there are some very normal kind of things that jive in the marketplace. Expect bullish trends to go back over previous lows. We can see that's very common to happen. The other thing that we can see is bearish moves. So as we can see, if we just take all the bearish moves from peak to bottom of the bearish trend, we can see it's roughly 22% down. Now, if we seclude out a little bit more, so if we just take the first two bear moves from the tech bust and the financial crash, we can see roughly we moved down 14.5% in that trend. So from peak to bottom in that trend, we do move down roughly 14.5%. The largest one was this percentage move that we actually had in the financial crash, where we went down 17.6%. And then all others during those bear moves, or the bearish moves down from peak to bottom, they were down roughly 26%. And some of them were down pretty good. You know, we had 29% down during one move during the tech bust. And then we had a 34% move down in the tech bust as well. And then the financial crash or the financial collapse, we had a massive drop of 43.5%, which was a monster. It was crazy. And then we did end out that bearish market with a 29% move to the downside. So as we start to analyze and look at our current situation, so we did put in a market high of roughly 480. We did move down 14.5%, so roughly pretty close to normal, 14.5%. And then we had a bullish response of 86.7%. That's a little bit above the average response in the first two bullish responses. And then we did move down here recently, as of this week, 16.5%. So that is another reason why I do think we will be bullish here over the next couple of weeks. It seems like we fell in line with what we can expect to the downside. A little bit more than what has been the average. Obviously not a lot of historical data here, just taking into account the past two real bear markets. So it's kind of interesting. Where do we think we're going to go? Well, I'm going to throw some numbers in here. So I'm going to enter some numbers into this box, and we will see potentially what the response is for the bulls, and we can see about what is in line with where we can get to. Now, I think 430 is a very solid area to get to. So if we get to 430, the bullish response would be about 70%. Well, I want to get a little bit higher than that. I don't really want this number to be around 70%. I want to get it a little closer to 80%, because that definitely seems a little bit closer to what we can expect from bullish responses, okay? So let's go ahead and say 440. And if we put in 440, it'll be roughly 85%. And that would be very much in line with what we were expecting this early into a bear market. Now, the early part of the bear market is very choppy, so we just need to understand that there's going to be a lot of chop here, okay? So that is why I do also think that we're going to get a little bit more of a buy up here, right? And we're just in a very choppy area. The other reason why I think we're going to get a little bit more of a buy up here, and we might get a little bit over 440. So if we get up to, like, you know, maybe 441.26, I don't know. I'm just pulling a number out of my rear here. So 441.06, because it's never going to be perfect. We're not really ever going to get to 440 perfectly. I do think we could see, you know, an overextension to the upside, right? Because we just saw an overextension to the downside, where on average in the first two bearish moves, we go down about 14.5%. Well, we just went down 16.5%. So it makes sense that maybe we do have an overextension to the upside, or potentially maybe we just don't overextend and maybe we just have an underperformance and we really sell off later. I don't think so. I think we will get to 440, because another similarity, so I'm going to put this back to 440. Another thing that was interesting to know is this number. So this number, and I'll mark this number for now, is as we got the second bullish response, that peak, we were actually down 7.5% in the tech bust, and we were down to roughly 8.5% in the financial collapse. What would be interesting if we got back to 440, one, it would be an overextension. Two, we would get back to within 8.5% of the all-time high. That would be a period of time where I think you would start to hear a narrative of, okay, we're within 10% of the all-time high. We are out of the correction. We can start being bullish. It's no longer a correction. I think you will hear that narrative. And I've said it before, once you hear that narrative, I think that is the time to go ahead and bail. So that's what I will be kind of listening for, whether you hear it on, you know, CNBC, you know, your Bloomberg, your news, whatever, you know, YouTube videos. If you see a YouTube video start popping up with thumbnails that saying, oh, we're out of the correction, you know, go bullish, you know, be careful, because it did this the two previous bear markets. Okay, so be careful of that. You know, when we get back within 10%, and if we want to know where 10% is, so it'd be about 432. If we start to get above 432, that would be within 10%. I would say start looking to take it off the table. Okay, start to be a little bit more protective. I do think we will get to about the 440 area. It just kind of makes a lot of sense. And I'll show you some more reasons why when we get back to the chart. So keep all this in mind. If you do want this data, I'll put it in the Discord. I will not link it because a lot of this is linked to a data I have here, and this file is too big really to put it in Discord. So I will take a lot of this raw data, or I'll kill the links and I'll just put it in Discord. That way, if you want to mess around with it, you can feel free to mess around with it. But there's some pretty good information. It definitely was eye-opening to do some of this info. Okay. One last thing that I wanted to show off. So I do have a column here, is the percent per day of the trend. Okay. So what was very interesting is you see that most of these moves, the percent per day, isn't all as much as what you might thought it would have been. Okay. Some of these moves were massive, as far as like a big move down of 34%, but it took a long time to do that. I mean, this move right here was a little bit over half a year. So it definitely took a while for some of these moves to play out. So definitely give yourself plenty of time and make sure you're going out far enough in time. So I've been hammering that one. But the interesting thing was this number on this percent per day and this number. If you notice, what is interesting about them is they're both bullish moves really before the bottom. That was very interesting to see. That is, this bullish move and this one were both over 1% per day before we went back down, made a new low, made a new bottom, and then that was the bottom. Okay, that's what I thought was very interesting to see. That the only other time we were over 1% was this one. We had just a rapid sell off at the beginning of the tech bubble, but we haven't seen a percent per day performance like that so far. So it'd be very interesting to see if that does work out this time. I do think if we do get one over 0.9 or 0.95, I think that would be roughly the point in time where that market might bottom, because we did get one here also in the tech bubble burst, but that was really the only other time. All the other times are around a 0.5% move, whether it's positive or negative for the trend, per day. So that was kind of just very interesting to see that really that number and this number really stood out, as that was the last bullish move before we rolled back over into a bottom. Okay, so that'll be a very good indication whether it's over 1% or maybe it's just really strong, maybe like a 0.9 or 0.95, who knows. But I thought that was very interesting to see that. So I got one more thing before we get back to the charts, where we think we can go. So some of you guys have seen me show this off before. It's been a few months since I've shown this off, okay? But what's very interesting is where we are on an exponential chart, price chart of the S&P 500. Now this goes all the way back to the early 30s, late 29, early 30. Now the dotted line you see here, this is the long-term exponential trend line, okay? Now what's interesting to see from this data is how many times we've gotten over it and we come back down to it, okay? So obviously we did back here during the Great Depression. We were really elevated as we kind of came into this data. I wish I actually had data that went back before that, but I pulled this data from Finance Yahoo. They just didn't have data that went back before that. But when we were above it in the 50s and 60s, we kind of came back to it multiple times. But the times that we got really above it in the tech bubble, that was the tech bubble burst. That was when we had the bear market, and we were also really elevated now, like recently, like the recent high that we put in. We were extremely elevated on an exponential level. So we can definitely see some pullbacks to roughly where this line is, which is about the pre-COVID high, okay? So we can definitely see where we can kind of pull back to over, a given period of time, over a couple years. And this is one reason why I haven't been exactly the most bullish person on the market, as we started to get really elevated on an exponential trend line level. I mean, it's just what it is. It's just mean reversion. We're going to revert back to the mean. We're just going to have a comeback to the norm, you know, and that's not really a big deal. We just need to understand that it's going to happen and find the best ways to protect our value. Okay, so let's go back to the charts. All right, so this was the 2000 to 2002 bear market. This was the financial collapse from 2007 to 2009. Okay, and then after that, we've been on a pretty much an historic bull market. So it's been very impressive. But has it come to an end? I think it has. So let's go ahead and try to figure out where we are going now. Okay, so I do think we probably put in a low, as this was just a normal, it was within tolerances of previous examples. So where do we go from here? Okay, so I'm not gonna get to the long-term picture. I think the long-term picture, this box down here, this is where that long-term exponential trend line is. And so we're a ways away from that. So let's just get into what we're looking at for the next few weeks. Okay, so obviously this was a pull down of roughly 16.5%. Okay, and we pulled down right here to this trend line that we've been going through for ever since this trend started back in 09. Okay, so we pulled right down to it, and it made sense. This was also a very important fib level to kind of be watching. So where do we go from here? Okay, so I did mention before 440, and it looks pretty much like that might be the case here. Now I'm going to draw something else here for you. So I'm going to draw a trend line from there, from the top to the first little bullish peak that we had. And what would be very interesting is if we pulled up roughly into the 440 area by mid-June. Now, if we did do that, maybe mid-June, maybe the beginning of July, but what would be very interesting if we did that is it would be really close to this trend line area. Now, if you did notice, and I highly recommend you just go back and look at 2000 to 2002 and then 07 to 09, is we never really made it back to the previous trend line of the top to the next peak, to the next lower peak. We never made it fully back to that level. So I do think we would get back to 440 before this trend line gets to 440, which would be early mid-July. Okay, so I do think it should happen sometime in June, and it might happen over the next 3 to 4 weeks. And if it does happen in the next 3 to 4 weeks, that also coincides with how long some of those trends kind of took, how long they took as far as trading days. Okay, so this scenario definitely does seem like it would probably work out if we got back to 440. Now, am I going to wait for 440? I don't know. I do have call options going out, so I think we could definitely get to 430 easily. I think that'll be the easy one. I think we'll get back into this yellow box zone. So I'm going to move this over. So I think we'll get back to this yellow box zone, and we might shop around there for maybe a week, a couple days, and then I'll think we will see a push back up out of it. And as we get up out of this zone, we'll be breaking that 430 level, and I think we'll just make a run to 440, and we will probably just hit it for a day, and I think that'll probably be it, and we'll probably just start to reverse. And I don't think we'll just turn over and crash. I think we'll just kind of slowly chop down for much of the year. I really do. I don't think it'll be anything crazy that we'll see for the second half of the year. I think we'll just slowly kind of chop down, and then we might see some acceleration as we kind of break down this previous high as the 4100 level or the 410 level. I think that's when we'll start to see some acceleration towards like October, November. Kind of makes sense to me. And then we can play some scenario analysis later on. But right now, I am definitely looking for that 440 pull up area, as it's just gonna freak people out. Like, do I go bullish? Okay, let's get in bullish. Like, people are going to respond here as the market gets back over 430, okay, as it gets back above this choppy zone. Now, the reason why this box on the longer term is down in this area is that'll be roughly when we get out there to that point in time in 2023 or so. That'll be where the long-term trend line is, okay? It's the pre-COVID high. I think we will get back into that area. Who knows where the bottom's actually gonna be, but I will be looking for a bullish trend that happens where it goes up about 1% per day. That was a key number that I saw that both the previous bear markets had. Okay, and it might not be 1% per day. It might be like 0.9, 0.95, but it was clearly so much stronger than any of the other percent per day moves. Okay, so we will definitely examine that later. I think we just need to see other levels set up before we get there, but we can't really call that yet. If we come down to this level and then we get a strong bounce, and then in that trend maybe we put in a 1% per day, then maybe as we come back down again, I would say, all right, let's get long, like everything in. But far away from that, let's just worry about the near term for now. And the two things I'm going to hammer on this again, the two things that we need to make sure we are doing as traders is reducing our risk size and going farther out in time on our options expiration. Okay, now obviously everybody's got their own trading style, but definitely buying time is going to allow us to stay in the game a little bit longer, stay a little bit more afloat. And the other thing that you could definitely notice as I go back to the 2000 time period is, if the market broke down and you tried to buy here off this weekly 200 moving average, but it broke down, if you didn't give yourself plenty of time on your options expiration, then you lost money. Then you were going to lose. But if you gave yourself plenty of time, you saw the market kind of come back, get back above that level, you probably could have taken a lot less of a loss, or maybe you just made it a small gain as you finally saw where the market bottomed. So give yourself plenty of time on some of these options. So I will go ahead and put the data that I showed off earlier in the Discord, and you can mess around with it. I won't link it to my data. I'll just cut it out. And then, I'll leave the formulas that link on this page. I'll leave those active. That way you can have those. But as for now, I am looking for a pull-up. 430 is going to be easy. I think it'll be the easy target. I think we'll get a little bit above that. I think we'll hit 440. The market will probably flip out and say, okay, time to go bullish. We're no longer in correction mode. And that's going to be the point in time where, no, you should probably bail. But anything above 432, remember 432 is that 10% from all-time highs type number that you will probably start to hear people talk about. Okay, we're out of a correction. And if we close above 432, people are going to talk about, okay, we're out of correction. We'll probably get one more thrust higher as people say, okay, we're out of correction. They come back into the market. We'll push up to 440 before we roll back over, probably a couple days later. So watch out for that, but definitely give yourself plenty of time on your options and enjoy your weekend. Alrighty, take care, Alpha Hunters.